Thanks for spending a few minutes with me today. This is Fiscal Therapy, real conversations for thoughtful financial decisions. Each episode is a calm, honest conversation about money, planning, and the decisions that shape our lives. I'm your host, Travis Flandermeyer. Today's guest is Phil Messuri, MS, CFP, an Air Force veteran, and a veteran of the finance industry. We want to thank our sponsor, Lakeridge Wealth Management, and I hope you enjoyed this conversation. Thank you for joining us.
It's a pleasure to be here, Travis. Thanks for the invitation.
What we're talking about today is somewhat timely, but it's probably, I would say, timely at all times. One of the most common questions that I receive from clients is what to do when the market drops. And that's a question that I receive when times are good and when times are bad, or whenever we have uncertainty. It's probably the most common question I get.
Yeah, I can understand that. With 30 years in the business, I think I end up with some of the same questions.
Well, let's start with the emotion of a market drop to put this conversation into context. Have you ever noticed how when the market drops, sometimes it feels like a disaster, but yet we have a year like 2025 and it just feels like a ho-hum win? That is because of a theory of loss aversion from a 2002 Nobel Prize winner, where we as humans are, emotionally driven, and we feel the loss twice as much as we experience joy with the gain. And that goes back from an evolutionary perspective of it's more important to avoid a predator than it is to find an extra berry. So we aren't always rational.
Yeah, that kind of makes sense to me. There are seemingly a variety of things, especially probably in people's memory, that have caused some of those fear factors even in the past 10 years.
Thinking of the 2020 market drop in March and 2022, so some recent memory there.
Yeah, and each one's a little bit different. COVID that you noted in 2020 didn't really kick in until all of a sudden everybody was supposed to stay home. And it was like, well, how is this going to affect the economy? And 2022 was recession fear that didn't come about. And then probably most recently, people remember, Liberation Day last April that also triggered a market decline.
With that in context, what would you say is the biggest misconception that people have with a market drop?
I think it's that people think that they should do something with their investments. And this may be even more so for people who are retired as opposed to people who have a job and they're contributing to their 401k.
Right. So it's a little bit different depending on where you are in life.
Yes, I would say it is. It also may have to do to some degree with, well, how much do you have? But yes, time in life, I think, is a big deal.
What are the most common mistakes that investors make in a market drop?
Making a quick decision to get cautious and then probably not coming back in when the signals are there for them to get back in, so they're out of the market during a time when they probably should have left things alone.
Yeah, I mean, you hear this from quite often. You see it in the financial literature, but it's not. To get out of the market requires being right twice in a very unpredictable environment, which is some people may get fearful and get out and be proven right. And I actually saw this happen to some people in 2020, but getting back in is even harder because getting back in tends to come when the news is even worse and the market's down. And oftentimes people get back into the market when the accounts or the market is even higher than when they first went out.
I definitely agree that, getting out is maybe an okay decision, but the getting in, it's frankly more complicated than the getting out.
Yeah. Yeah. I can think back to 2008 and people in 2009, 2010 saying, I'm just waiting for things to calm down before I get back in. And by that time, they'd missed a tremendous run in the market. Why does reacting emotionally during a downturn often make things worse?
Probably because in many people's situations, the opportunity that's lost for their accounts to grow is missed, and there isn't any way to double up and catch up based upon, let's say being out during a time when you shouldn't have been out at all.
We can't get those days back if we miss a significant gain by being out.
No, and somebody really probably shouldn't then take a higher equity position, than what they're comfortable with in the thought that they can double up and catch up. That's almost compounding the problem, I think.
Yeah. Yeah, you touch on higher equity position than what they're comfortable with in the rebound, but likewise, it's important to make sure that your stock to bond ratio is something that you're comfortable with before the market drop, so that you can be thinking opportunistically and getting perhaps more equities when the market drops than selling, right?
Yeah, two things maybe come to mind, Travis. Oftentimes, my recommendation to people is to have an account where the market isn't going to affect it to speak of. They've got money for the next couple of years that's going to supplement their income, or it's part of their retirement income flow. And if that account is feeding them, then they can leave the other account alone, which is the way I have tried to perhaps protect mostly the clients from a downturn that can really, really frighten them.
You mentioned something about time frame a few questions ago. How should long-term investors think about market drops differently than short-term investors?
Well, I can think back to COVID when you and I are working together, as we continue to do today. But the COVID downturn, following more or less people being required to stay at home, there was a market drop of 34% as by the S&P. And this was the opportunity for people to potentially take a higher equity position. So as I recall, there were some recommendations by us to selected clients to actually either get back into the market or actually take a slightly higher equity position. That is not often the case, but in that particular case, I think it served them well, because once the administration started pushing money out to people and it looked like economically we could weather COVID, the market did a pretty quick rebound in the summer of 2020.
Yeah. And I would add, time horizon is critical in that decision, because for money where someone might need it in the next 2 to 3 years, totally different story. We're not looking to get more aggressive in that scenario with short-term money, because that's truly, back to that intro comment, you can't afford that loss. You can't afford to have that money not be available if it's short-term money. But long-term money, you can let it recover.
If we're talking about these three recent events, meaning COVID, 2022 recession fear, and Liberation Day, in all three cases, we've seen fairly quick recovery times. A little bit different than 2007 or 2009, but I'd say people had to be ready for all of the above.
We'll often hear comments that a market drop or the ebb and flow is a natural part of financial markets and investing. Why is that? Why should we not worry every time that we see the market dip?
History would be the simple answer, and then the data that kind of backs up the history, again, using the S&P. A 5% decline in the S&P happens 3 to 4 times a year, depending upon the period we're looking at. A 10% decline happens every year to year and a half-ish. And we've actually seen 20% drops in these examples we're using that happen with some regularity. I'd compound that with the fact that the S&P number is high enough that 10% of that figure can be pretty shocking. So it's shocking in the news, and the news, unfortunately, doesn't guide investors to making the smartest choice. fear can rule.
Yeah. Yeah. I think you touched on history too, and I think it's important to note because people forget about even 2018, but we've seen market drops at least touch that 20% mark in 2018, 2020, 2022, and early 2025. So these are very normal types of volatility and fluctuation.
Yes. And then maybe the reality of these things differs. What I mean by that is nobody really knew how COVID stay-at-home would impact the economy. But this was worldwide. It wasn't just the U.S. If we take the present conflict in the Middle East, I don't think we really understand how the price of oil may impact life in the next 60, 90 days. So you have some uncertainty. But it's not the same thing as a worldwide recession of 2007 to 9. So I think also trying to look at what's triggering the loss if somebody is actually trying to bring some rationale to a little bit of an understanding of should this be prolonged or not.
So shifting gears a little bit to the concept of financial planning, we like to say we start with a plan. And that's critical to keep in mind as well when the markets are dropping or in any volatile period. Can you comment how maybe having a financial plan can benefit somebody in periods of volatility?
Yes. If the plan helps somebody understand where is their money coming from, let's say not only this year, but maybe for an anticipated event, you're going to get the house stuccoed, you're going to get the roof fixed. If it's clear to them that the money's going to flow and it's not dependent upon the market, you've already taken a little bit of the fear away. And so the plan can kind of say, well, here's your normal flow of money. Here's your emergency reserve that should have no equity or little equity. And then let's then say that the plan says this is your midterm money, this is your longer term money. So time tiering of money, sometimes called the bucket strategy, to me can be the plan that can help people emotionally cope with these volatile market issues.
Yeah, I totally agree with you. In my experience, the time tiering of money has been kind of a comfort blanket when we've had periods of volatility when people were concerned. Those who have that type of an approach or have been open to that approach have not been, in my experience, anecdotally, they haven't been as concerned as those who didn't. On the other hand, I would add to something that, the plan, in my view, can be grounding, where you have a period of market volatility. People often think, well, how is it impacting me? And am I still going to be able to do X, Y, and Z that I had hoped and forecasted? And I think that's the opportune time to re-review those plans, because oftentimes we find that our plans have been built with some buffer and cushion, and we like to be conservative when putting those together so that we account for market volatility, and volatility does not tend to derail somebody's financial plan.
If that concept that the financial plan should be there so that they're not derailed, then that alone should give that particular person some confidence that they can withstand a modest amount of volatility without then doing something that can hurt themselves in the long run.
That's the key, is in general, staying invested to the extent that you're comfortable with it. How can a market, market drops can also be opportunities. Can you talk to that a little bit?
Like I noted, COVID was an example of opportunistically people could get slightly more aggressive if they chose to do so. A market decline might also mean that there's a holding you have that maybe you haven't been in love with, and so maybe the value of that asset is down. Maybe this is the opportunity to sell that asset and replace it with something that you're more comfortable with. So I think a decline can be treated as your friend in some regards.
I would add that it's important when the market drops to shift someone's thinking from fear to opportunity. It's an emotional benefit to be on the offense versus the defense. And if if the goal is to come out of any market drop with more shares in stock than what you entered it, and therefore you're buying these shares at a discount, you have more shares for the recovery, and you actually recover faster. So that can be an opportunity, I would say, as well. So let's touch on planning strategies. So we've danced around it a bit. Can you talk about some planning strategies that can help when the market drops?
I think we've already noted one, that you would have potentially short-term accounts, mid-term accounts, and long-term accounts. I think that can be one strategy, and the allocation in those three different buckets is different. So that's part of the strategy of having conservative money, maybe money that's going to cautiously grow for some event. You want to buy a house, you're going to buy a car, going to take a vacation. And then there's long-term money that, unless really something goes wrong, maybe you're never going to touch that money. Oftentimes that could be something like a Roth IRA.
So the key is to know where your money's coming from for the next 3 to 5 years.
Yes.
So that you can let that more stock-heavy account recover and play out through any volatility.
Absolutely.
That's your buffer. That's your safety net. That's your moat, I would say at times, right?
Yes.
What's one thing that investors should avoid doing in times of a market drop?
I'd say making too quick a decision, maybe not asking the right question if they have an advisor, calling the advisor or the advisory team and kind of saying, what do you think? I had an example earlier this week. This is a good client of ours, yours and mine. And he said, is this the right time for us to get more cautious with their accounts? And what I said was it was too early in what was occurring in the Middle East for us to say this is the right time to get out. So I actually asked him, why don't you put this on hold and let's have a discussion in a week? So buying some time, however you want to do it, can be in your favor.
Yeah, gathering information,
Yes.
asking the right questions,
Yes.
asking questions in general, right?
Yeah, my own comment, I would say the market has not reacted as negatively since the onset of the Middle East war as many really anticipated. And this includes the fact that the Straits of Hormuz are, for all intents and purposes, they're shut. And we are seeing the price at the gas pump go up. And yet, so far, the U.S. markets, world markets, have not seen any real precipitous decline.
And what's one mindset shift that could help people stay calm during a market drop?
I'll jokingly say don't drink too much coffee. The market, I think the mind shift would be pause, take a deep breath, try to read about it, try to talk to a professional about it if they have a professional in their life.
Yeah, I think that's great advice. Well, times are always changing, and uncertainty, as we kind of noted before, is constantly popping up. That's a natural. That's the world that we live in. Times are always interesting, aren't they?
They certainly are.
Yeah. Well, thank you for joining me. I think this is a really key conversation to have, and again, probably one to consider not only when things are going, when we have volatility, but when times are calm as well, because positioning a portfolio and creating a financial plan can be something that people lean on when the next uncertainty occurs.
Yes, and the certainty is that there will be something uncertain and upsetting that will occur sometime down the road.
Certainly.
Thank you very much for having me.
Thanks for joining, Phil. This is great.
Thank you.